Chapter 10, Learning Objective 1. Identify and explain characteristics of the corporate form of organization and classes of shares. The accounting equation expresses the relationship between assets owned by a corporation and the claims against those assets by creditors and shareholders. Accounting for equity in a corporation requires distinguishing between the two main sources of shareholders' equity: share capital and retained earnings. Share capital is the amount shareholders have paid to purchase ownership interests in a company. Retained earnings is the total net income earned by a company over its life that has not yet been distributed to shareholders via dividends. Corporations are legally separate from their owners, who are called shareholders, and each unit of ownership of a corporation is called a share. Corporations can have privately held shares or publicly held shares. A privately held corporation's shares are not issued for sale to the general public, whereas a publicly held corporation offers its shares for sale to the general public, sometimes on a stock market like the Toronto Stock Exchange or the New York Stock Exchange. A corporation has some of the same rights and obligations as individuals. For instance, it pays income taxes on its earnings, it can enter into legal contracts, it can own property, and a corporation can sue and be sued. A corporation also has distinctive features. 1. It is separately regulated by law. 2. It has an indefinite life. 3. Its owners have limited liability. 4. It can usually acquire capital more easily than an individual. A corporation is formed under legislation enacted by a country or a political jurisdiction within it. In Canada, a corporation can be formed under either federal or provincial laws. Although details may vary among jurisdictions, a legal document variously described as articles of incorporation, a memorandum of association, or letters patent is submitted for consideration to the appropriate government by prospective shareholders. The document lists the classes or types of shares that will be issued, as well as the total number of shares of each class that can be issued, known as the authorized number of shares. When approved, the government issues a certificate of incorporation. Investors then purchase shares from the corporation. They meet and elect a board of directors. A shareholder or group of shareholders who control more than 50% of the voting shares of a corporation are able to elect the board of directors and thus direct the affairs of the company. In a large public corporation with many shareholders, minority shareholders with similar ideas sometimes delegate their votes to one person who will vote on their behalf by signing a proxy statement. This increases their relative voting power, as many other shareholders may not participate in shareholders' meetings. Shareholders usually meet annually to vote for a board of directors. The board meets regularly, perhaps monthly or quarterly, to review the operations of the corporation and to set policies for future operations. The board may decide to distribute some assets of the corporation as a dividend to shareholders. It may also decide that some percentage of the assets of the corporation legally available for dividends should be made unavailable. In this case, a restriction is created. Corporations are generally subject to the following regulations. 1. It must provide timely financial information to investors. 2. It must file required reports with the government. 3. It cannot distribute profits arbitrarily but must treat all shares of the same class alike. 4. It is subject to special taxes and fees. Despite these requirements, a corporation's advantages usually outweigh its disadvantages when compared to other forms of business, such as a proprietorship or partnership. Next, we discuss a corporation's indefinite life. A corporation has an existence separate from that of its owners. Individual shareholders may die, but the corporate entity continues. The life of a corporation comes to an end only when it is dissolved, becomes bankrupt, or has its charter revoked for failing to follow laws and regulations. The corporation's owners are liable only for the amount that they have invested in the corporation. For example, if you invest $1,000, and I invest $10,000 into a corporation, I have more to lose than you do if the company defaults. If the corporation fails, its assets are used to pay creditors. If insufficient assets exist to pay all debts, there is no further liability on the part of shareholders. This is in direct contrast to a proprietorship or a partnership. For the protection of creditors, the limited liability of a corporation must be disclosed in its name. The words limited, incorporated, or corporation, or the abbreviations Ltd, Inc., or Corp., are often used as the last word of the name of a company to indicate this corporate form. Issuing shares allows many individuals to participate in the financing of a corporation. Both small and large investors are able to participate because of the relatively small cost of a share and the ease with which ownership can be transferred. Shares are simply purchased or sold. Large amounts of capital can be raised by a corporation because the risks and rewards of ownership can be spread among many investors. A corporation only receives money when shares are first issued. Once a share is issued, it can be bought and sold a number of times by various investors. These subsequent transactions between investors do not affect the corporation's balance sheet. Because corporations are considered separate legal entities, they pay income taxes on their earnings. To encourage risk-taking and entrepreneurial activity, certain types of corporations may be taxed at rates that are lower than other corporations and individual shareholders' income tax rates. This can encourage research and development activity or small company startups, for example. There are many types of shares that are characterized by differences in voting rights, dividend rights, liquidation rights, and other preferential features. The rights of each shareholder depend on the class or type of shares held. Every corporation issues common shares, with rights and privileges usually attached to them as follows. The right to participate in the management of the corporation by voting at shareholders' meetings. The right to receive dividends when they are declared by the corporation's board of directors. The right to receive assets upon liquidation of the corporation, and the right to appoint auditors through the board of directors. For other classes of shares, some or all of these rights are usually restricted. The articles of incorporation may also grant the shareholders the preemptive right to maintain their proportionate interests in the corporation if additional shares are issued. If the company is successful, common shareholders may receive dividend payments. As well, the value of common shares may increase. Some corporations issue different classes of shares in order to appeal to as large a group of investors as possible. This permits different risks to be assumed by different classes of shareholders in the same company. For example, a corporation may issue common shares but divide these into different classes like Class A and Class B common shares. When dividends are declared, they might only be paid to holders of Class A shares. Preferred shares are a class of shares where the shareholders are entitled to receive dividends before common shareholders. Preferred shares usually do not have voting privileges, and preferred shareholders typically assume less risk than common shareholders. In return, they receive only a limited amount of dividends. Issuing preferred shares allows a corporation to raise additional capital without requiring existing shareholders to give up control. Preferred shares are also listed before common shares in the equity section of the balance sheet because they have preference over common shareholders. The shares of a corporation can have a different status at different points in time. They can be unissued or issued, issued and outstanding, or issued and reacquired by the corporation, called treasury shares. Authorized shares are the total number of shares that a corporation can issue. Unissued shares are shares that have not yet been sold, whereas issued shares are shares that may have been sold, but may have also been repurchased by the corporation. Issued and outstanding shares are shares that have been sold and are held by investors, whereas reacquired shares, also known as treasury shares, are shares that have been issued and were once held by investors, but have now been reacquired by the corporation. These reacquired shares may be reissued or cancelled at a later date. Cancelled shares are prevented from ever being sold again. Many factors influence management in its choice between the issue of debt and the issue of share capital. One of the most important considerations is the potential effect of each of these financing methods on the present shareholders. Consider the example of Old World Corporation, which has 100,000 common shares outstanding, is a growth company, and is profitable. Assume Old World requires $30 million in cash to finance a new plant. Management is currently reviewing 3 financing options. 1. Issue 12% debt, due in 3 years. 2. Issue 300,000 preferred shares, $8 per share annual dividend. 3. Issue an additional 200,000 common shares at $30 each. Management estimates that the new plant should result in income before interest and tax of $6 million. Here we can see results under each of the three alternatives, starting with income before interest and taxes of $6 million. Plan 1, the debt issue, has interest expense of $3,600,000, calculated as $30 million times 12%, resulting in income before taxes of $2,400,000 for this plan. The other two plans, which are equity options, don't have any interest expense, so the income before taxes for both plans 2 and 3 is $6 million. Assuming a 50% income tax rate, we have income taxes of $1,200,000 for Plan 1 and $3 million for Plans 2 and 3. This results in net income of $1,200,000 under Plan 1 and $3 million under Plans 2 and 3. We would then consider preferred dividends applicable under Plan 2, the preferred share issue, of $2,400,000 calculated as 300,000 preferred shares times $8. Plans 1 and 3 don't have any preferred shares. This results in income available to the common shareholders of $1,200,000 under Plan 1, $600,000 under Plan 2, and $3 million under Plan 3. Notice here, there's something we haven't seen before: earnings per common share, or EPS. EPS is the amount of the income available to the common shareholders expressed on a per-share basis. The amount of net income earned in a year can be divided by the number of common shares outstanding to establish how much return has been earned for each outstanding share. EPS is calculated as net income less preferred share dividends, divided by the number of common shares outstanding. EPS is quoted in financial markets and is disclosed on the income statement of publicly traded companies. For our example, the EPS under Plan 1 is $12 per common share, calculated as $1,200,000 in income available to the common shareholders divided by 100,000 common shares. For Plan 2, EPS is $6, calculated as $600,000 divided by 100,000 common shares. And for Plan 3, the common share issue, EPS is $10, calculated as $3 million in available net income divided by 300,000 common shares. In this example, Plan 1, the issue of debt, has several advantages for existing common shareholders. The first advantage is earnings per share. On this basis alone, the issue of debt is more financially attractive to existing common shareholders, higher EPS. The second advantage is control of the corporation. Creditors have no vote in the affairs of the corporation. If additional common shares were issued, there might be a loss of corporate control by existing shareholders. The third advantage to issuing debt relates to income taxes expense. Interest expense paid on debt is deductible from income for income tax purposes, whereas dividend payments to shareholders are distributions of retained earnings, which is after-tax income. Dividends, therefore, are not tax deductible. There are also disadvantages to debt financing. The most serious disadvantage is the possibility that the corporation might earn less than $6 million before interest expense and income taxes. The interest expense is a fixed amount and must be paid to creditors at specified times, unlike dividends. Debt must be repaid at maturity, whether or not the corporation is financially able to do so. Shares, on the other hand, do not have to be repaid.